Hi friends, welcome to the channel JIV and CIV Made Simple. Today we are going to revise our IIBF CTP, that is Certified Treasury Professional Module C, D and E, which are based on investment, forex dealing and derivative. So from examination point of view, if I talk about these three modules, so you can say that bond investment is a very important topic. Actually they ask numerical question, but numerical question can be cleared if your theoretical base is strong. Once your theoretical base is strong, once you know all the formula, then only you can solve the numerical question. And in this particular lecture we are going to cover everything in the short term. See, I am not going to explain everything because this is a quick revision session. If you want the proper explanation, you can enroll in our CTP video course. There you will get the proper explanation of each and every part. So let's get started. When you invest in a bond, your return does not come from just one source. There are actually three main parts to the return, right? First of all, you get the interest payment. So this is also called the coupon income, right? Interest payment also called the coupon income. It is a regular interest that the bond issuer pays you, like the rent for using your money. That is called interest payment. Second thing, we have a capital gain or capital loss. This happen when you sell the bond before maturity or at maturity, right? Suppose if you sell it for more than what you paid, you get a gain, and if it is less, you sell it for less than what you paid, you face a loss. And the third thing is the reinvestment income. This is the extra return you earn when you reinvest those interest payments instead of keeping them idle. See, first of all, you have interest payment from bond. This is also called the coupon income. Second thing, there is a capital gain, capital loss. Third thing, there is a reinvestment income, which means the extra return you earn while you reinvest those interest payments instead of keeping them idle. So in simple word, bond can make money for you in three ways: interest, profit on selling and reinvestment. So interest payment means regular income from issuer, capital gain and loss means profit and loss on the sale or maturity, and reinvestment income means extra return from reinvested coupon. Now friends, let's talk about the type of yield that we have. So the first kind of yield we have is called the coupon yield. So what is the meaning of this coupon yield? So basically, this is the fixed percentage of the face value, right? This is a fixed percentage of the face value, and it is unaffected by the market rate or inflation. So it means what, inflation or market rate does not affect the coupon yield. So let me give you one example. Suppose I say 100, suppose we have a 100 rupees bond at the rate of 8.24%. So what will be the yield? Yield will be simply 8.24%. This is the most popular topic, current yield. They ask you question every year. So please understand what is current yield. So current yield is annual coupon divided by current price into 100. So it ignores the reinvested income. So suppose 100 rupees is the par value or face value and it is sold at 103 rupees. So what is the current yield? So what is the coupon it is giving you? Suppose 8% is the coupon rate. So 100 rupees, 8% of 100 is 108. So 8 rupees coupon it is providing you. So in the numerator you write the coupon, that is 8 rupees, right? In the denominator you write the current price. So what is the current price? It is 103. So 8 divided by 103 into 100. That would be near about 8%, near about 8%. That is your current yield. And then the third kind of yield we have is called yield to maturity. In short we call it YTM. This is the total return if held till maturity, which means if you held the bond till maturity, the total amount of return that you get is YTM. So these are the three yield which we used most popularly. And if we talk about the discount rate, what is the meaning of discount rate? See, we have the future cash flow, right? We find the present value of all those future cash flow, right? So that is basically what we are doing. We have a cash flow available. We find the present value of all those cash flow, right? And discount rate is equal to market price. So basically, there is an Excel tool which are used to solve these kinds of problem. I'm not going to explain all those things, right? Now, so remember, coupon yield is fixed, current yield is market based, and YTM is total return till maturity. Now friends, let's shift our focus to the day count convention. See, when it comes to bond or money market instrument, we often need to calculate how long we have held the investment. That is where day count convention comes into picture. What does it mean? It simply means the method used to count the number of days between two dates. This helps in calculating the accrued interest, right? So this is the method. Right now we are talking about day count convention. It is a method which we use to count the number of days between two days, and using this method we calculate the accrued interest. What is the meaning of accrued interest? Basically the interest earned between two coupon dates, that is called accrued interest. There is a convention. This convention makes sure that everyone in the market follow the same standard so that interest calculation remain uniform. If we talk about the bond market, the standard method is 30 upon 360. which assume that every month has a 30-day and every year has a 360-day. But in money market, we use actual upon 365, which means we take the actual number of days in a month and assume 365 days in a year. So this method is usually applied for instrument like treasury bill, right? So in short, we can say it's just about setting common ground for how we count days while calculating interest. So let's quickly revise the key point which we have covered. We started with the purpose of this day count convention. I told you it helped to calculate holding period as well as the accrued interest. If we have bond market, the notation is 3/360, which means 30 days a month and 360 days a year. And if you look at the money market, the convention is actual upon 365, which means actual day and 365 days per year. Right, the goal is to ensure uniform interest calculation across the market. That is our goal. Now let's talk about the bond duration, or we call it the McLeod duration. Very, very important thing. So whenever I say bond duration, what does it mean? It measures the time to recover the investment in PV terms. Right. See, we have an investment in the form of bond. Right. How much time does it take to recover the investment? So how to find the how to go about finding the McLeod duration? It's very simple. Remember, McLeod duration question is asked every examination. So please make sure that you have practice. And if you want to practice more, you can take our previous year question. Look at the previous year question PDF available in the course. I have explained every step by step. Right? Please solve those questions. So let's see what are the steps. First of all, we have the future cash flow available. We discount them using the bond yield, and then we get the present value, and you have to multiply each present value by its time period, right? And then find the sum of all, right, and divide by the bond price. So summation of PV into T upon summation of PV. This is the formula to find the McLeod duration, right? So and suppose the bond is semi-annual. In that case, you divide it by 2 to get year, right? So this is the point. So if you look at the key characteristics of this duration, you can see this is like a weighted average time to receive the cash flow. If the coupon is higher, so duration will be shorter. And duration is always less than equal to maturity of the bond, except zero coupon bond. Suppose that we have a zero coupon bond, and if they ask you to compute the duration, do nothing, just see the maturity. Maturity is exactly equal to the duration, right? So question may be asked, for which of the following bond duration and maturity are equal? Option A, some option they will give you. So remember, the answer is zero coupon bond. So remember, duration shows the price sensitivity, right? Higher duration means higher interest rate risk. Now, if you look at so till now we are talking about the McLeod duration. Now, modified duration, it's just a smarter, more practical version of McLeod duration, right? Modified is a smarter and practical version of the McLeod duration. It tells us how much a bond price will change if interest rate change by 1%, right? So it measures the price sensitivity to a 1% change in the yield. So how much the bond price will change if interest rate change by 1%. You can think of it like sensitivity meter for the bond. It measures how sensitive the bond price is to the interest rate change. For example, let's suppose we have a 15-year bond. It has a duration of 7. So it means that if the interest rate rises by 1%, the bond price will fall by about 7%. Right, that is what it indicates. So basically, McLeod modified duration simply measures, it very well that bond price and yield are inversely related. Whenever yield change positive, bond price change negative. So how much there is a change in the bond price whenever the yield change, right? That is what is measured by the modified duration. So basically, higher the duration, more sensitive the bond, bigger the price change with every rate movement. Remember, this is the basic equation, right? More duration, more bond sensitiveness, more the price change with every rate movement. So let's quickly revise the key point. We started with modified duration, which is a kind of improved McLeod duration. It shows the percentage price change for 1% yield change. 1% rise in yield is equal to price fall roughly by duration percentage. Higher duration means more price sensitivity. I hope this is crystal clear now. Now, there is some term like PV01, that is called present value of 1 basis point. So, what is the meaning of it? What is the meaning of 1 basis point? 1 basis point means 0.01%. Suppose there is a shift in yield by 0.01%. Shift means it can increase or it can decrease. Both things can happen. So, PV01 measures that since the yield changes, so price is bound to change. How much the price is changing because of that changing yield? That is what is measured by PV01, right? I hope it is clear. What is the meaning of DV01? DV01 means the dollar value of 1 basis point. So it shows that, suppose yield gets shifted by 1 basis point. So whenever I say shift, it means it can increase or it can decrease. That is the meaning of shift. So let's suppose that yield gets shifted by 1 basis point. So how much the NPV will change? What is NPV? Net present value will change, right? So it indicates the currency value change, and it is not limited to dollar, and it is closely, the DV01 is closely related to PV01 with slight calculation difference. Now this topic is the most hot topic for examination, that is called convexity. So what is the meaning of convexity? Bond price is non-linear, right? And adjustment for the non-linear bond price is done using the convexity. So let's understand it. Basically it reflects the change in the duration. Yes, duration also change. See, till now we were talking that when the yield change, price change. Obviously price will change, but sometimes when the yield change, duration also change. So this convexity reflects how the duration will change when there is a change in the yield. Now to suppose we have an option free bond. So what happen, whenever yield increase, price will fall, right? Price fall is less than the duration estimate, and yield will decrease, price rise is greater than the duration estimate. So remember, duration is a kind of linear estimate, while convexity is like kind of curve reality correction. Now friends, let's switch our focus to the forex and market segment. So forex, or this is the short form for foreign exchange. It simply means the trading of one currency for another, like exchanging rupees for dollar when you travel abroad. So forex means foreign exchange. It means foreign exchange. What does it mean? It means trading of one currency for another. But it is not just about travel only. It is actually the largest financial market in the world, where bank, companies, investor, they trade currency for global business and investment. Right. Unlike the stock market, forex is decentralized. What is the meaning of it? It means that there is no single exchange or location where the trading happen. Right. That is called decentralization. You cannot say that this is a single exchange or this is the location where trading happen. Instead, all the trade takes place over the counter, OTC, through a network of bank, broker, electronic system across the world. That is the meaning of decentralization. Again, I am repeating. So when I say decentralized, it means that there is no single exchange, no single location where the trading happen. It happen throughout over the counter, through the network of bank. In short, forex is a global online marketplace where currencies are constantly being bought, constantly being sold, 24 hours a day, 5 days a week. Right. So that is the peculiarity of this forex. So let's recapitulate the key points. So forex means currency trading for global transaction, world largest financial market, decentralized it is, which means OTC, over the counter, no single exchange, all are electronics, and trading happen globally through bank and network. Please remember these keywords. Next term we have is called swap. Right, swap. So let's talk about the swap market and forex trading in India. But before that, let's look at some characteristics of this forex market. So remember, this is an interbank level, and so there are 3 levels: interbank level, brokerage level, and retail level. So what happened at the interbank level? Major bank, liquidity provider are there. Brokerage level, broker execute trade for the client. And retail level, what happened? Individual trade via aggregator. So that this forex market happened at the 3 level. Now obviously it is a global connectivity, 24/7, not 5. 24/7 operation is there. It link dealer and market maker, right? So what a spot market? So this is a kind of segment. So whenever I say this word spot market, what does it mean? That immediate currency exchange at the current rate, whatever rate is prevailing right now, and currency exchange is happening at that particular rate. That is called the spot market. So the key feature of a spot market is that instant settlement, minimum volatility risk. Volatility does not impact these kinds of market. Second kind of market we have is the future market. See, whenever I say this future market, what happened? This is a kind of contract, and a standardized contract for future exchange at the fixed rate. It offers stability, it offers predictability to large trader. Third kind of market we have is forward market. Like it is just like a future, but customizable terms, higher flexibility. Fourth, we have the option market. So whenever you see this word option, please remember this is a right, not obligation, to exchange at the fixed rate before a set date. It enables strategic speculation or hedging. So just remember these keywords. A spot means now, future means fixed future, forward means flexible future, option means choice without obligation. Right? You have a right, but you don't, no obligation is there. Now let's look at the swaps. Swap is basically a financial agreement between two parties. So two parties are there. They are undergoing financial agreement where they exchange cash flow, or where they exchange sometimes the value of asset. That is called the swap. So friends, swap is a kind of financial agreement between two parties where they exchange cash flow, or sometimes they exchange the asset value. Right? You can think of it like this. One party agree to pay a fixed rate while the other party pays a variable rate, which is often linked to the interest rate or foreign exchange rate. So this is how the swap happen. So these deals are not traded, right? Remember, these deals are not traded. These deals are not exchanges like a stock or future. Instead, they are customized, right? They are customized and privately arranged between the two party. That is what we call, OTC trading. So question may be asked whether the swap deals are traded on exchange like a stock and future. No. They are customized one. They are privately arranged between the parties. Okay, one party agree to pay a fixed rate, other party pays a variable rate, right? And the biggest advantage of the swap is that is flexibility, right? Which means both sides can design the contract as per their need. In short, we can say swap help institution manage risk or adjust cash flow according to the changing market condition. So friends, some points related to swap I just talked now, that it is kind of derivative contract for exchanging cash flow or the asset value. One leg is fixed, other leg is variable. OTC deal it is, which means not traded on exchange, and quite flexible, quite customizable to suit both the parties. Now friends, nature of swap just now I told you, right? So basically this is a privately negotiated deal, right? It's not a standardized futures and options contract. It is tailored contract to suit participants needs. And multiple styles are there to match the trader goals and temperament, like scalping. So this is an ultra short term trade, small profit, high frequency, day trading. So what happened in the day trading, all the trade within one day, happen within one day. Then we have the swing trading. Swing trading, it is a medium term like day or week, right? It captures the market swing. Then we have the position trading. Position trading, what happened, it is a long term, week, month based on fundamental trend. So if we talk about scalping, what happened, that basically we are trading rapid trades, and it's aim at tiny price move. And this scalping rely on leverage and large position. It needs sharp analysis. It does not need any patience. And style selection, the success depends on matching trading style with temperament. Now if you look at the day trading, this is the second type of swap arrangement that we have. So day trading means you are buying and you are selling within the same day. You enter and exit a trade before the market closes. The goal of day trading is to make quick profit from a small price change that happened during the day. The day trader often use high leverage. Yes, this is the key advantage. They use high leverage. What is the meaning of high leverage? It means they borrow fund to take larger position. And this can increase profit, but it also increase the risk if the market move the other way. You will mostly see day trading in forex and the stock market where price move to frequency. So what we have talked just now, I told you that swap, swap is a kind of customizable derivative. Scalping deals with speed, day means daily action, swing means short trend, and position means patience. Please remember these words, very, very important. So day trading, I told you, now you are buying and you are selling within the same day. The goal is to make quick profit. Day trader use the leverage, right? And you will mostly see day trading in forex and stock market. A typical day trader, is someone who is well informed, financially strong, and he or she is ready to act instantly on breaking news like interest rate change, inflation data, or global event. That is called day trader. In short, day trading is all about speed, timing, and discipline. It's not about holding position overnight, but also about capturing the intraday move. So just now, let's quickly revise the key points. Buy and sell same day, right? Use high leverage, common in forex and stock market, and day trader are educated, quick, and trade liquid asset. Remember these key points. Now then we have the swing trading. So if we talk about the swing trading, they target short to mid-term gain. They are based on the technical analysis of the market swing, right? And as compared to scalping, monitoring required is less. The fourth kind of swapping technique we have is called position trading, which is a kind of long-term strategy, right? Position trading is a kind of long-term strategy. Please note it down. And they focus on the sustained growth. And one who is a fundamental investor, he want to learn everything. So for them, this position trading is the best method. Now if we talk about the forex quotation, so you can see that when I say quotation, what does it mean? It shows the exchange rate between two currency. Suppose we have a currency pair and we want to know the exchange rate, so that can be known through the forex quotation. Like suppose I say euro per dollar is 1.104, 1.1404. So that means 1 euro is equal to $1.1404. If you look at the ISO currency code, it is a kind of 3-letter standard code set by ISO, right? International Standard Organization for global use, like EUR for euro, USD for US dollar. So remember, day means daily action, swing means short trend, position means long vision, and quotation means currency pair logic. Now let's switch our focus to the essential of exchange rate and forex transaction. Very important topic. So exchange rate simply tells us how much one currency is worth compared to the another. For example, suppose I say $1 is equal to 84 rupees. It means you need 84 Indian rupees to buy 1 US dollar. You know, this rate keep changing daily depending on global demand and global supply, right, of the currencies, trade flow and interest rate. And you know, this exchange rate is the core foundation of all the forex transaction. It is the core foundation of all the forex transaction, because you know, every foreign exchange deal, whether it is for import, export, travel, investment, they depends on this exchange rate. So in short, we can say the exchange rate is just the price tag of a currency when compared to another. It's just the price tag of one currency. So whenever you see this word exchange rate, it means what? You know, price of one currency in terms of other. For example, $1 is equal to 84 rupees. And you know, this changes daily. That depends on the demand, supply and market focus, and is the foundation for all the forex transaction. Now friends, let's look at the what is the rule regarding the forex transaction, right? Let's look at some rules. So basically, you know, there is something called, you know, variability in rate, right? Variability in rate, and then we have the you know, sell transaction rate. So here you can see there are two ways to quote. The first way is called direct method. Second way is called indirect method. So direct method means, you know, you have a fixed foreign currency, variable local currency. Like suppose I say $1 is equal to 61.50 INR, right? So here what we can see that our foreign currency is fixed, like dollar is fixed, and our local currency, which is Indian rupees, is variable, right? So, and you know, this is used in India since August 1993. And if you talk about Japanese yen, they are quoted per 100 unit due to the low value. Then we have the indirect method, indirect currency, indirect quotation. What happened here? You know, we have local currency fixed, our local currency is fixed, and foreign currency is variable. For example, let's suppose I say 100 INR is equal to $1.6260. So these are the two kinds of quotation that we have. If you look at the types of forex transaction, so they are classified as purchase or sale by bank, based on whether the bank acquire or whether the bank releases the foreign currency, depending on what is happening. So either, you know, bank is acquiring or bank is releasing. So they are either purchase or sale, purchase transaction or sale transaction. If we talk about the purchase transaction, as the name suggests, the bank receive the foreign currency from where? So bank may receive foreign currency from exporter, right? They may receive from exporter, or they may receive foreign currency using FCN, foreign currency note, TC, DD, inward remittance, right? Then we have the sale transaction. Sale transaction means bank provide the foreign currency to whom? Obviously bank will provide the foreign currency to the importer, right? So these are the two kinds of sale and purchase transaction that we have. One more point is that direct means one FC in the LC value, indirect means one LC, one local currency in the FC or foreign currency value. Purchase means bank get foreign currency, sale means bank give foreign currency to the importer, right? Now there is something called variability in rate, very important. So you know, in forex market, not all transactions have the same exchange rate. The rate actually changes depending on the types of transaction. Why? Because each kind of transaction has a different level of processing, different level of documentation and handling cost, right? So because of this reason, you know, there is a variability in the rate. So that is why I told you that in forex market, not all transactions have the same exchange rate. Different forex transaction, different rate. The rate actually changes depending on the types of transaction. So I told you now, for example, suppose you are sending money abroad through a telegraphic transfer, let's say TT, right? So if you are sending money abroad through a TT, it's, you know, it's quite quick, it's quite simple. But handling an import or export bill involve checking documents, following up, collecting payment. So the rate offered by the bank will obviously differ. So in short, we can say that, you know, that the more complex the process is, the less favorable the rate for the customer. So what we just learned, let me just summarize. I told you that different forex transaction, different rates will be there, and it depends on the processing complexity and handling effort. Simpler process, better rate. Complex process, lower rate. I hope it is crystal clear now. Now, what is the influence of the interest rate? Let's talk about it. So influence of the interest rate on the forex form, I will talk about it. Before that, let's look at some purchase transaction rate. We have something called bill buying rate. So bill buying rate is to be used for, you know, export bill, and you know it very well that lower the rate, this rate is lower because of the extra processing. And then we have the TT buying rate. This is for, you know, inward remittance, right? Inward remittance we use the TT buying rate. and it is better rate, simpler process, right? And if you look at the other instrument rate, so there is a separate rate for the foreign currency note and traveler check. Now, what is the influence of delivery timing? Rate code depends on the delivery timing a lot. Very, very important thing. Rate quotation depends on the delivery timing, which means settlement date, and it reflects the timing of the deal finalization. So you can see the TOM. First type is TOM. Right, okay, ready or cash. Whether we call it ready or cash, both means the same thing. So what is the meaning of ready or cash? It means same day and immediate settlement happen. TOM is tomorrow. Tomorrow means next working day, and the gap is for 1 day. Then we have the spot. Spot means 2 working day, and this is a kind of a standard forex deal. Forward happen after the spot at premium or discount based on the currency demand and supply. So remember, telegraphic transfer is the fastest. Bill is a process heavy. Forward means future deal with premium and discount. Now, if we talk about the influence of interest rate on forex forward rate, let's understand this. Very, very important. Interest rate link. The forward exchange rate between two currencies is not random. It is mainly driven by difference in interest rate of the two countries involved. Right? Very, very important thing. That the forward exchange rate between two currencies is not random. Rather, it is driven by the difference in interest rate. You can think of it like this. If you are holding one currency, there is a cost, there is a benefit depending on that country interest rate, right? So what I'm telling you, that suppose you are holding one currency, there is obviously a cost of fund, right, or benefit depending on that country interest rate. So the forward rate adjusts itself to reflect this cost of carrying or holding a particular currency over the time. Yes, that forward rate adjusts itself. There is a cost. If you are holding one currency, there is a cost or benefit depending on that country interest rate. In simple word, we can say the forward rate bridges the gap between the current rate and the difference in the interest rate between the two currencies. This is what the forward rate does. So remember, forward rate depends on the interest rate differential. Very, very important thing. And it reflects the cost of holding fund in each currency. Forward rate ensure that fair pricing for future exchange rate, right? So you can see the trend here. Suppose there is a higher interest rate currency, so that will be in discount in the forward contract. If it is lower interest rate currency, it will be premium in the forward contract. How do we compute the forward rate? It is very simple. If we have the direct quotation, we just take the spot rate. If it is premium, just add it. If it is discount, just subtract it. And that is how you will get the forward rate. And if it is indirect quotation, then you have to do the opposite. So remember, forward rate adjusts for interest rate gap. Higher rate currency, cheaper forward. Low rate currency, costlier forward. Please remember this point. Now currency identification. So there is a 3-letter ISO codes. Please understand it. Every currency in the world has unique 3-letter ISO code, like USD for US dollar, INR for Indian rupees. So there is no confusion in international trading. And currencies are also classified based on how widely they are traded. There are some major currency which are most popular and highly liquid globally. There are some minor currency which are traded often but less than the majors. Exotic currency, there are very rare, or emerging market currency, often riskier and less liquid. So in short, we can say ISO code make it easy to identify currency, and classification tells us how widely they are used in the forex market. So remember, ISO code is a unique 3-digit currency identifier. Major, higher trading volume and liquidity. Minor, moderate trading. Exotic, emergency or less traded higher currency. Let's talk about some prominent name they have given you, right? Now let's talk about the currency pair, right? So currency pair, major pair I told you, minor pair, exotic I told you, exchange rate quotation, I think we have discussed all these things, right? Now exchange rate fundamentals, very, very important. Let's clear the fundamentals first. So bank quote exchange rate based on whether they are buying or whether they are selling the foreign currency. When I say purchase rate, it means when the bank buy foreign currency from you, it uses a rate aligned with the market buying rate. And when the bank sell foreign currency to you, it uses a rate aligned with the market selling or acquisition rate. So there are two kinds of rate, purchase rate and selling rate. Purchase rate means when a bank buy foreign currency from you, right? So in that case, that rate is aligned with the market buying rate. That's called purchase rate. And second case, when the bank sell foreign currency to a client or to you, right? So there's a rate. It uses a rate that is aligned with the market selling rate. In simple word, bank always adjusts its rate depending on whether it is giving you money or it is taking from you. So quick way to remember it, you must remember it. Purchase rate means bank buy foreign currency. Sell rate, bank sell foreign currency. Principle is, rate differ based on bank buy or bank sell action. That is what decides, right? Now you can see market merchant rate is just like interbank spot rate plus or minus exchange margin, right? And margin varies by the transaction type. So there are some currencies they have mentioned here, like dollar. Maximum spread from mean rate is 1%. For GBP, Euro, Australian dollar, CHF, and JPY, maximum spread from mean rate is 2%. Other currency minimum feasible. Now let's talk about the merchant rate formulation. So it's basic simple. Buy low, sell high. So if you have purchase transaction, then you take the base rate, you subtract the margin. Remember, the margin is always to be subtracted in the case of purchase transaction. And if it is a sale transaction, we take the base rate and we add the margin. So it ensures that competitive pricing for the client. So remember it. Now let's talk about the TT buying rate. TT buying rate is the rate at which that the bank use when it receive foreign currency from abroad. It is like inward remittance or deposit. Suppose a bank is receiving for foreign currency from abroad, like inward remittance. So in the case of inward remittance, we use the TT buying rate, right? Suppose it is commonly applied to some cases. Let me tell you some cases, like export proceed, right? Bill collection is there, or suppose refund is there, cancellation is there. So in these cases, TT buying rate will apply. It also convert foreign deposit or loan into the Indian rupees. Now the question is how to compute this TT buying rate. Very simple. First of all, we take the base rate, which is the market purchase price of the currency. We adjust for any exchange margin. What is exchange margin? It is a very tiny percentage deducted by the bank, and we round the final rate to the nearest paisa for the client. In short, we can say TT buying rate is the bank rate for crediting foreign currency to your account. So this is the simpler way to understand. Suppose bank is crediting foreign currency to your account. The rate that we use, right, after applying minor adjustment, right, that is called the TT buying rate. That's called inward remittance, right? So remember, TT buying rate is the rate for inward remittance, and step is, first of all, you take the base rate, you deduct the margin, and you round off. And it is applied to export proceed, like bill, RFC, EFC, FCNR deposit. In this kinds of thing, you apply the TT buying rate. It is just the bank rate for crediting the foreign currency to your account. That's it. Second rate we have, is called bill buying rate, or we call it OD buying, right? So what it is, suppose you are purchasing a bill, you are discounting a bill. When I say purchasing and discounting, I think you are familiar with it. What bank do? Bank pay rupee now, and it will receive foreign currency later. That is called the discounting of bill. So Ujans bill, you apply the forward rate, and side bill, no forward rate is there. We apply the spot rate, right? That is the point. So remember, TT buying is the rate for inward remittance and deposit conversion. Bill buying is the rate for export bill and delayed forex receipt. Now let's talk about the refined methodology, right? So bill buying rate in terms of dollar. Now friends, the bill buying rate, that's called BBR. It is a rate that the bank use when it buy export bill or when it buy the draft in the foreign currency, especially for the future delivery. So since the payment is not immediate, right? Very important thing to note is that if we talk about the bill buying rate, payment is not immediate. It's a usance basis, right? So what we do, we apply a forward premium, a forward discount is applied to the current spot rate. So let me give you an example. Suppose the base rate is 61.50. So I say that $1 is equal to 61.50 rupees. Then we add a forward premium. Suppose our forward premium is 0.60. Right? So subtotal it become how much? 62.10. And then we deduct the margin. Margin is suppose 0.15 or 15%. So final BBR is 62.01. That is called the bill buying rate. So in short, we can say that BBR, that is bill buying rate, it adjusts the spot rate for future delivery. So remember, bill buying rate is used for export bill and deferred payment. And TT buying rate is used for inward remittance. Okay, just now I have told you. Now the question is, in the TT buying rate there was no premium. Why in the bill buying rate there is a premium? Because bill buying rate deals with those cases where the bank pay the money now and bank will receive payment at the due date, right, of the bill. That's why premium comes into picture. Now friends, let's talk about the TT buying rate in terms of traveler check and dollar. Okay, so whenever we purchase the foreign currency traveler check, how do we deal with it? First of all, you take the base rate, deduct the margin, right, and subtotal round it to the nearest paisa. That's it. Now we have currency note buying rate, CN. This is the purpose is simple to purchase. Friends, TT selling rate is the rate that a bank charges when it sends the foreign currency abroad. TT buying rate, inward remittance. TT selling rate, outward remittance. Right. So how to compute it? Very simple. Take the base rate, add the exchange margin, and you get the final TT exchange rate. Right. So in simple term, TT selling rate is the price that you pay to buy the foreign currency from the bank. It includes small charges for handling and processing. So friends, please remember these points. TT selling rate for outward remittance. First of all, we take the base bank rate, then we add the bank margin and you get the final client rate. Remember, margin is always to be added in the case of sell transaction and margin is always to be subtracted in the case of buying transaction. Please remember it. Right, so this is the point. TT buying rate, TT selling rate. Now let's talk about the financial derivative. Financial derivative, and before that it is TC selling rate. Traveler check selling rate. Again, it is very simple. You are selling the foreign traveler check to the client. Very simple. Take the base rate, add margin, and that's it. Then we have the currency note selling rate. We call it CN selling rate. So that is all about, you are selling the foreign currency notes to the customer. Take the base rate, add margin, you get the foreign currency selling rate. So these are the steps that you have to follow. TT, bill, TC, currency notes, etc. etc. Right. Now let's talk about the cross rate. So what is the meaning of cross rate? We use USD dollar as an international intervention currency. Remember, this is called intervention currency. So the dollar is used to derive INR rate for non-USD currency. So it's very simple. Let's suppose I say that $1 is equal to 61.50 rupees and $1 is equal to 1.1377 CAD. Now you can link this Canadian dollar with the rupees using the dollar. Dollar is acting like an intervention currency, right? So you can simply say that 1 CAD is equal to 61.50 divided by 1.1377, which is equal to 54.07 rupees. So this is how cross rate works. Now let me give you some example of the matching transaction. You know it very well that this transaction is used to align export proceed with import obligation to minimize the interbank exposure, right? So this is applied as no spot dealing risk exists, right? So qualification criteria is that transaction amount should be nearly equivalent, that means plus minus 10%. Like suppose I say inward $50,000, which is near about outward $45,000. So remember, in the case of cross rate, dollar acts like a bridge. Match transaction offset trade risk plus lower margin. Now let's switch our focus to the derivative. So derivative, it is a financial contract whose value come from something else, like a stock, commodities, currencies, or market indices. That is derivative. So derivative are essentially an agreement between two or more parties where the payoff depends on how the underlying asset price move. Right. So we are talking about derivative. So for kinds of financial contract, value come from something else, a stock, commodities, currencies. The best part is that they are quite versatile. You can use them. You can use derivative to protect your investment. That's called hedging. You bet on price movement. You can use derivative to bet on price movement. That's called a speculation. Or you can leverage your money for higher potential return. So in short, we can say that derivative are financial tool that link value to the underlying asset. So first point is that asset linked value is there. So that means depends on the stock, commodities, currencies, or indices. Contractual between the parties, right? Some uses I told you: hedging, speculation, and leverage. Now just now I told you the functions of derivative. Functions of derivative, first is the hedging. Hedging means protecting the portfolio from adverse price movement. Then we have the speculation. Speculation means profit from anticipated price change. If you look at the user of the derivative, so the first user is the hedger, right? Hedger is a user of derivative. Hedger means what? He safeguard investment, reduces volatility. Speculators also use derivative to seek profit from the price swing. Arbitrager, he exploit market price difference for risk-free gain. Leverage seeker, he amplify return with a small capital. If you look at the types of derivative we have, the first kind of derivative is option. You know what is option? Option means you have the right but not the obligation to buy or sell at a predetermined price. Then we have the future. Future means a standardized contract to buy or sell at a fixed price. Right, this is a kind of exchange traded contract, options, future. So remember, derivative it includes risk tool plus profit opportunity. Key users are hedger, speculators, arbitrators, leverage seekers. Now let's look at some derivative instruments that we have. The first instrument is called future. You know what is future? Future are the standardized contract traded on exchange. Right, it obligate you to buy or sell an asset at a fixed price on a fixed date. Right, so it's kind of exchange traded contract, a standardized one. You can buy or you can sell at a fixed price at a fixed date. Very liquid and it is easy to sell, easy to trade. Then we have the forward contract. Forward contract is customizable over the counter deal. Future is a standardized, while forward contract is OTC deal. They have flexible term, and in terms of liquidity, as compared to future, they are less liquid. Third kind of derivative purpose, we have FRA, forward rate agreement. So this is the kind of forward contract on interest rate for a notional amount. So this is a kind of forward contract on interest rate for a notional amount, and it helps in hedging the interest rate risk. Then we have the forward, we have the swap. So forward is also an OTC. See, We have seen that forward is an OTC contract. We have also seen that forward contract is an OTC contract. If you look at the swap is an agreement to exchange cash flow, to exchange instrument, right? So let me just summarize. Future, standardized, exchange traded, high liquidity. Forward, flexible, private OTC contract. FRA, which means forward on interest rate. Swap, exchange rate, cash flow or asset for the risk management. Now let's look at the strategic use in the risk mitigation, right? So counterbalance adverse movement in the asset, interest rate, forex exchange, commodity, right? These are the points. So derivative includes two things: hedging and speculation. Swap and FRA are for interest rate management, and forward offer you flexible OTC contract. Now let's look at the derivative for commodity risk and speculation. Let's talk about it. So we can mitigate the commodity price risk. So futures as an option, they lock price in advance and they protect producer from adverse price movement, right? Then we have the protective puts. What it is all about: you buy put option on appreciated stock and you have the right to sell at predetermined price. Then you have the speculating on asset price movement. So you take position to profit from expected price change. And there is a high risk and reward which offer you potential for substantial profit or losses. Leveraging derivative, right? If you talk about the leveraging derivative, it means larger exposure with less capital, which amplify the return as well as the risk. So this is all about the derivative. Remember, derivative, already I told you what is the meaning of derivative. Now one more point is forward contract. Let's talk about the forward contract. So forward contract is a custom agreement. It's kind of OTC derivative to buy or to sell an asset at a specific price on a future date, right? So this is a kind of custom agreement. Custom is customizable, right? People use the forward contract either to hedge. Hedging means what? Protecting, right? Protecting themselves from price swing, or to speculate. Speculate means betting on future price. So in simple term, we can say that forward contract let you lock a price today for a transaction in the future. So remember, forward contract is an agreement to buy or sell at a fixed future price. Purpose is hedging, or hedging means reducing the risk. Speculation means profit from the price move. So remember these two words: customizability and flexibility, right? These two are a very, very important thing. Now this is tailored for specific commodities. Over the counter nature, which means it operates outside the centralized exchange, right? That is meaning the OTC nature. And it offers highly customization, but higher counterparty risk is obviously there. What is the meaning of counterparty risk? See, so counterparty risk arises when suppose one party default, right? He does not comply with the obligation. In that case, obviously a risk is there, and that risk is called counterparty risk. Okay, so it includes agriculture, energy, precious metals. All things are included under the forward contract. Please note it down. And now let's look at one example of the contract executions. That's what we're talking about. So imagine a farmer selling 20,000 bags of paddy at rupees 4,500 rupees per bag 6 months from now through a forward contract. They choose cash settlement, right? Meaning instead of delivering the paddy physically, the price difference is settled in cash to manage the price risk. Okay. Now in simple terms, the contract locked the selling price today, giving the farmer protection against the future price change. Right. So what I have told you, that forward contract example I have given just you, that suppose you are selling 20,000 bag at 4,500 rupees in 6 months, price difference paid in cash instead of physical delivery. The purpose is very simple: to protect against the future price fluctuation. Then we have the future, we have something called future trading. Yes, let's look at this future trading. What is the meaning of future trading? It is an agreement to buy or to sell an asset at a set price on a future date. See, in the case of forward contract, it was just a customizable deal, not an agreement. Whether this is a kind of agreement, right? People use future to lock in price, protecting themselves from the market fluctuation, or they can also use to speculate on price movement for potential profit. In simple word, we can say, that future let you pay plan ahead by securing a price today for something you will buy or sell later. That is the future contract. That's the gist of future contract, right? Some trading platform I have just given you the name of, right? Now let's talk about the future contracts, some more important points. So future contract cover many type of asset, like it may cover energy future, like crude oil, gas, gasoline, heating oil. It includes equity futures, like single stock or single baskets, It includes interest rate future like hedge or bet on change in the bond or treasury rate. It includes precious metal future like gold, like silver, which safeguard against economic uncertainty. It includes stock indices future, which is linked to indices like S&P 500. Right. So there are different kinds of future we have. Some peculiarity of future trading they have mentioned that future contracts are always standardized, means quantity, quality, delivery terms are fixed, and this makes trading smooth and trading efficient on exchanges because everyone know exactly what they are buying and what they are selling. And the benefit are transparency, high liquidity and accurate pricing, no confusion, no dispute about the contract term. Right, remember these key points. One more point is that so what we have talked just now is standardization, which means fixed quantity, fixed quality and delivery. Benefit I told you already. Now future trading overview, let's talk about it. So friends, let's talk about the overview of the future trading. Here you can see the first point they have mentioned is the strategic price protection. Future contract help business and investor protect against the unpredictable price change. For example, suppose there is a company which is buying oil, they can lock in a price today for delivery later, ensuring budget stability as well as safeguarding the profit even if the market price changes. So purpose is quite simple: to stabilize budget, to protect profit, and to lock future price today. That is the main point. Okay, and this future act like an invest, but there are some drawback also, like and sometimes loss get amplified beyond initial margin. Opportunity loss is always there, so some favorable gain they may miss it. So these are some kinds of disadvantage that we have. Then future as investment vehicle. So basically that futures have two main purpose for investor. First thing is speculation, second thing is hedging. Speculation means you can try to profit from price change without actually owning the asset. You have not owned the asset, yet you are trying to profit from the price change of the commodity. That's called a speculation. Second thing is hedging. That's called dual purpose utility. Hedging means what? Hedging means you can protect your investment from loss if the price move unfavorably. Yes, suppose the price move unfavorably, in that case you can protect your investment from loss. This give investor flexibility to manage risk or chase profit strategically. Right, some inherent risk is always there. You can see hedging misstep, so wrong opposing position can amplify the loss. Daily price volatility is there, right? So speculation, which means gain from price movement. Hedging means protect against market decline. So remember, futures are the flexible tool for strategy as well as the protection. Now let's talk about the options. Let's talk about the option, what it is all about. So option are financial contract whose value depends on another asset. So option value depends on asset like stock, indices or ETF. They give investor flexible way to invest or manage the risk. So some points they have mentioned like derivative. Derivative value come from the underlying asset. Then flexibility, a strategic investment tool it's like. There is something called contractual flexibility. So the buyer of an option has the right but not the obligation to buy or sell the underlying asset. Unlike future, you don't have to execute the trade if it is not profitable. So remember, buyer right but not obligation. Future is mandatory execution. We have the word that's called expiration and pricing. So option have a fixed expiry date. You must decide to act before this date. And the strike price is the agreed price at which you can buy or you can sell the asset. So remember, expiry date is like a deadline to act, and a strike price is a preset transaction price. There are some terms like market accessibility, which means options are easily traded online via digital platform, via broker, making them accessible to most investor. So they are accessible via brokerage and online platform. Strategic versatility. So option allow hedging, speculation, earning income. Two main types are there: call option, which means right to buy; put option, right to sell. So call means buy, put means sell. Purpose is very simple: risk management and profit strategy. If you look at the contract dynamic, please understand that buyer pays a premium to get the right, and seller, who is also called the writer, he takes on the obligation to fulfill if the buyer exercises. So buyer means buyer is right, seller obligation. If you look at the call option mechanics, so call option let you buy the asset at a strike price within the expiry date. Yes, there is an expiry date for every option. Within the expiry date, you can buy the asset. And the call option is based when you expect price to rise. That's called bullish market. When you expect the price is going to rise, then you can exercise the call option, right? Bullish market. So call means buy right, and bullish market expectation you can use this call right. Then let's talk about the put option. So put option means what? That it gives you the right to sell an asset at a pre-agreed price, right? That is called a strike price, but not the obligation. It is useful when you expect the market to fall. That's called bearish market, right? And want to profit or protect your holding. So put means right to sell and use it the bearish market outlook. Market sentiments. Option reflect market mood. Call option means buyer expect price rise, optimistic market, and seller expect price fall, pessimistic market, right? And put option means buyer expect price fall, pessimistic market, seller expect price rise, optimistic market. So remember, call is optimistic for buyer, pessimistic for seller. Put means pessimistic buyer, optimistic seller. Strategic motivation, investor can use option for leverage, hedging, income generation, commodity access. These are the keywords, right? There is some terms, two important numbers that help the trader. That's called daily trading volume, which means how many contracts are traded that particular day. Open interest. Open interest means what? The total active contract, right? So some types of option they have mentioned, like American option, which means A for America, and you can A for any time. You can exercise your option anytime before expiry. This way you can remember A for America, A for any time. You can exercise your option anytime before expiry. Second type we have European option, which means you can exercise only at the expiry date. E for European, E for expiry. This way you can remember it. A for American, A for any time. E for European, E for expiry. Right? Exercise means you can use your option to buy or sell an underlying asset. So American means anytime, European means at expiry, and exercise means you are activating your right. Now, call option give the right to buy at a strike price. If you have a long call, it means buy if you expect price to rise. Profit, unlimited profit if the price rises, and loss you have to pay the premium, right? Obviously. So quick revision, let's just talk about the points. Call means buy right, long call means bullish market, and maximum loss you can have is the premium. Put option similarly gives you the right to sell an asset at the strike price, right? And long put means profit if the price if the price fall. That's called bearish market. That's called long put. And protective put means act like a floor to protect the portfolio value. So put means selling right, long put means bearish play, protective put means safeguard holding, right? Remember these keywords. Now let's talk about some more important points, characteristics of options. Now friends, options comes in two style, American option and European option. An American option means A for America, A for any time. You can exercise option any time before expiry. And European option means what? You can exercise only on the expiry date, right? So American means any time, European means expiry only. Then we have the market prevalence. What does it mean? So most US stock indices, they use European style option, and individual stock usually follow the American style option. Remember, indices can be European, and in single stock means American. Then we have the premium implication. American option are costlier than European one because of the early exercise flexibility. And if we talk about the vanilla option, they are very simple, a standard option to buy or sell at the strike price. So friends, if we compare American option and vanilla option, so vanilla option are very simple, a standard option to buy or sell at a strike price, and American option are costlier than European one due to early exercise flexibility, right? So question may be asked, if you look at the contract structure, so standard option usually cover 100 share per contract, like premium is 0.35 rupees per share, total will be how much? 35 rupees per contract, and premium depends on strike price and time to expiration. So remember, contract means 100 share, premium has two components, strike and time. Then let's talk about the expiration dynamics. So option expire like perishable goods, daily, weekly, monthly, quarterly, and most monthly option expire on the third Friday of the month, right? So expiry means timing matter, and monthly option means third Friday. Remember these key points. Okay, so these are the points. Now let's talk about the strategy and risk analysis in terms of option. So friends, that trader often use option spread. Right, trader use something called option spread. Option spread means you are buying or you are selling the option together. That is called option spread. Which means why to do that? So to customize the risk and reward, they use option spread. Who? Trader. And this strategy work in upward, downward, neutral, volatile market, all kinds of market. This option spread option work very well. The potential gain, the potential loss are often shown in the profit and loss diagram, like buy call spread, or something called iron. They use the word iron condors, right? So option spread means tailor risk reward, and the diagram is a visual payoff. Now let's talk about the risk assessment. So Greek help trader measure risk in option or portfolio. The Greek quantify how the option react to the change in the underlying asset or other factor, right? So there is something called delta. Delta shows how much an option price change for 1 rupees change in the underlying asset. Suppose there is a 1 rupees change in the underlying asset, how the option price will change, that is measured by delta. If we have call option, that means delta 0 to 1. it moves in the same direction as the stock. If we have put option, which means delta 0 to -1, it moves opposite to the stock, right? For example, call delta 0.50, it means stock increased by rupee 1, so option increased by 50 paisa. So call means positive delta, put means negative delta. Delta indicates the price sensitivity. If you look at the hedging utility, so delta help in hedging the position. For example, I say call delta 0.40. It means you sell 40 share of the underlying to neutralize the risk, right? So remember, this is called delta. So option Greek plus Greek like delta, they help trader strategically manage risk, right? These are the points. So just now I told you about delta. So delta can also be seen as the profitability of an option ending in the money. It can also be seen as a profitability of an option ending in the money. You know, in the money, at the money, out of money. For example, suppose I say call delta 0.40. So it means there is a negative 40% chance that this option will be profitable at expiry. Right, please remember it. There is something called theta. Theta is called time decay. Theta measures how much value an option loses each day as it gets closer to the expiry. Right, it measures how much value the option loses each day as it goes closer to the expiry. For example, I say theta 0.50. It means option loses 50, there is a currency name, per day, right? So it means 3 days it will lose 1.50 rupees. So behavior, you know, at the money, if it is at the money, it means, you know, time decay is very faster. And if it is out of the money, it is a slower decay. You can think of it like this. And gamma, you know, gamma is called delta sensitivity, which means it shows how delta change when the underlying move rupee 1. For example, suppose I say call delta 0.50 and gamma I say 0.10. It means stock increases by rupee 1, delta increase by 0.10. So trend, you know, it's very simple trend that it peaks for at the money option, lower for in and out of the money option, increases as the expiry nears. It amplifies the risk reward sensitivity. Now gamma shows how sensitive delta is to the price change. Longer dated option, gamma is low, delta does not change much. And if it is a near expiry, so what happens, you know, gamma rises, right? Delta reacts sharply to the small price change. So friends, that is all we need to revise from this particular module C, D and E. Since this was a revision session, so I have covered the most of the topics, but some topics are left. If you want me to cover that also, then I will cover in the next session, right? And if you want any kind of study material for CTP, please WhatsApp me on this particular number. I will provide you the study material, and many aspirants have passed using the study material. So this is a foolproof. As you get to access the concise notes, you know, unit wise MCQs as well as the previous year question paper. That's all for today. Thank you.